Hey everybody, good to be here. My name is Brent Moore. It's time for Advanced Option Strategies. You know, each week in this class we talk about different things. Last week we talked about earnings, one approach at least to earnings, and we'll follow up on that, follow up those trades that we did last week. But this week we're going to focus on calendar spreads. We're going to go something that isn't really looking for a big move in the stock. We're going to more of a neutral forecast, if you will. We'll do that next. I'm joined alongside Barb Armstrong in the chat. She's awesome. Barb is awesome. Check out her classes if you haven't. She teaches trading a smaller account. She teaches getting started with technical analysis and others, I think. So, and I appreciate her. So as you have questions, feel free to type those in. You can follow myself or Barb on X at Brent Moore's CS, at Barb Armstrong CS. CS is Charles Schwab, if you did not figure that out there. But options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application, which we will be using, is for educational purposes only. Although I do encourage you, excuse me, I do encourage you to try out some of these trades on paper money here and just to experiment. That's how you learn, is doing them on paper money, so you're not taking the full risk of the trade. But that's how you can learn a lot of these strategies. All investing does involve risk, including risk of loss. I won't factor in commissions very often on these trades I show you, so just be aware that that is a real thing that you need to pay attention to. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And, I'll be using specific stocks, specific options today. Those are not recommendations there. So here's what we're going to do. I want to follow up on last week's trades. Actually, first I have a little special announcement here. I want to follow up on last week's trades, and then I want to discuss calendars kind of in general, and then look at specific examples on calendar spreads. And those last two things will be kind of intermixed, I guess. So this is the special announcement. The special announcement is this. If you're interested, we have live workshops that go around to cities around larger metropolitan areas around the country. And here are three of them that I would encourage you to consider. If maybe you're in the Phoenix area. Scottsdale, well, boy, March 7th, 8th, still probably kind of cold wherever you're at. Not in Scottsdale, probably not a guarantee, I guess, but check out that. We have an advanced option strategy. That's quite apropos to this class, isn't it? Advanced option strategies workshop in Chicago, March 21st, 22nd. And in Detroit, that's going to be our normal workshop there, not advanced options, April 11th and April 12th. Okay, so here's what I want to do. I want to go and I want to bring up, we're on Thinkorswim here, and I want to go through last week's trades. Now, for those of you who were not here last week, I did straddles, both long straddles and short straddles on earnings, specifically to take advantage of earnings. And so that's a particular earnings trade. And that's kind of appropriate because we have a lot of companies that are still coming out with earnings, right? I mean, we had Apple last night, we had Microsoft and Tesla, the day before, and Meta. But there's still a lot of companies out there that have earnings. You can see that here's the S&P 100, all those that have this, blue and red circle deal means that they have earnings coming out. So we did earnings trades last week, but now you're going, well, it was just long straddles, short straddles. Today you're doing calendars. Can you do calendars on earnings, Brent, is what you're asking. The answer is yes, you can. I'm not actually going to focus on that today, but I do have a class that I did specifically on using calendar spreads for earnings. And that occurred on October 18th, October 18th of 2024. So if you have the watch list, which I put in if you're watching live, I put it in the chat. Go to that watch list. You can bookmark that October 18th webcast on calendar spreads on earnings. Then you can check that out. So I'm doing calendars today, but I'm going to avoid earnings today, to be honest. And if you want last week's webcast, where I go over long straddles and short straddles, you can check that out as well. But we did 2 trades last week. One was, let me just go to my account statement. This is how you can find past trades, by the way. Go to your account statement. Make sure you have an appropriate time frame here. Okay, make sure you're on the right account, first of all. If you're not on the right account, you're not going to see it. Go back to an appropriate time frame, because typically I think it defaults to 1 day back from today, which isn't going to show you probably what you want. But we did 2 trades last week. We did a long straddle and a short straddle. Let's start with the short. We'll start with the bad news first. Here was the short straddle. Now, the short straddle was, look, we don't want this company to move a lot. Well, what happened? Apple decided to move a whole bunch. So we sold this for upfront. So when I say sell it, this was the initiating trade here for $10.35. So that's $1,035. We brought in the account. However, it went against us and we bought it back. We had an exit in here programmed in to get us out if it went against us, and indeed it did. And it cost us $1,908 to buy back. That means we lost about roughly $870 on that trade. Okay, bummer. That's too bad. That's because we were looking at Apple, and we're saying. And we did this right on, let's see, what day is that? The 24th. We did it here. And then what happened on the day after? Boom, it went way up. And I don't remember exactly where we had our exit, but we got out, okay? So that was Apple. The other trade we did was we did Caterpillar, okay? And we did a long straddle on Caterpillar. We paid $1,800. Well, we still are in that trade right now. Let's see, where's Cat? I know I have it. There it is, right down there. And you can see we're up $1,600 on that trade. So between the two, we won one, we lost one. This one has done very well, and now's the time to get out. So I'm just going to exit this trade, because on a long straddle, which was an attempt to take advantage of a big move on a stock, which it did, I'm not going to let this go to expiration. I'm just going to, because look, this one's in the money. I want to get out of this. Now, I can stay with, let me get rid of this left-hand column. My put is in the money, and I don't want this this will auto-exercise, okay? This will auto-exercise at expiration, which is in a couple hours from now. The call is out of the money. That's not going to auto-exercise. And there's no point in me, it's not really worth anything right now because the mark is a penny. So I don't have to get out of both of them, but I'm going to get out of this long put here. So I'm going to right-click on this. I'm going to create that closing order, and we're going to look to get out, and that's going to be a nice little profit for us here on this one. And I just want to make sure I get out, so I'm going to move that over there. And we're going to send that, and we're out of that trade. That was a nice little trade here. Okay, now let's move on to the subject at hand, which is calendar spreads. Okay, calendar spreads. Let's go to, oh, by the way, just before we do that, this was the trade we were looking at last week. We said, we want this to move out of this box. I kind of highlighted this box here. What did it do? It moved way out of the box on earnings. That's why, so sometimes they work out, okay? That's great. So what's a calendar spread? A calendar spread is a spread, like we have a lot of spreads here, but it's a particular spread where we're going to choose the same strike price for both our long option and our short option, but they're across different expiration dates. Okay? Different expiration dates. So, and I don't have any in right now, but the way they work is we're trying to take advantage of, and here's the gist of them. We're trying to take advantage of the more rapid time decay in the short option because we're going to have higher theta on an option that's going to expire soon than the amount of theta on that contract that's dated farther out. So you'll see, I'm going to show you this in just a minute here. But when do we use these and whatnot? So let's just kind of talk about that, and then we will get on to them. So calendar spreads, this is going to be kind of more neutral-ish is our forecast on that. I put ish because you can kind of slide them up or down just a little bit depending on what strike price you want. You want the stock to go near the trade. The way we're teaching them, they're going to be a debit spread. We're going to sell the near month. We're going to buy the later date. Okay, so these are just the basic details on a calendar spread. This is going to be a theta positive trade. In other words, time decay is going to help us out on this trade. And we'll look at specific examples here shortly. It's going to be a Vega positive trade as well. This gets a little bit more complicated. Vega positive means, what does Vega positive mean? Vega positive means that if implied volatility goes up, in general, that's going to benefit the trade. Okay? That's going to benefit the trades. If implied volatility goes down, in general, it's going to work against the trade. But when I say Vega positive on this, and I'm going to do this, I'm going to compare like a calendar, butterfly, condor here in just a sec. But it's a little bit, it's not as straightforward on this trade as it is a lot. Because we have different contracts of different expiration dates, and often they don't work in tandem with one another. So George said, look, do we need a low IV to enter the trade? The answer would be, I think a lot of traders would say, no, we don't necessarily need a very low IV to enter a trade. It would probably be more of a cautionary note if the IV were very high, unless we're specifically targeting an earnings calendar, which I mentioned earlier on that. But to me, it's not the most important factor to have a very low IV, although that could be helpful in the trade. And of course, liquid stocks or ETFs is what you're going to be looking at. And I mentioned neutral already. I wrote that down twice there. And so here's kind of one more that I'm going to say, and then we'll move on. I'm going to look to sell 20 to 50 days, and I may actually even violate that here today as we look at some of these trades, because I want to show to you that you don't have to be rigidly adhere to this sell-buy time frame that I'm saying. But in general, more often than not, I'm going to say we're going to sell 20 to 50 days, and we're going to buy 50 to, I don't know, 120 days or something like that, okay? And that's when we're entering that trade. So that's kind of just the bare bones of what we're going to be looking at here on a calendar spread. But let's kind of compare, because, you know, if you think of a calendar versus a butterfly versus an iron condor, they're all kind of fall in that neutral camp, don't they? They do. They do. They all fall in that neutral camp. Time decay, you know what? Theta is positive for all three of these. So no real difference there. There is a lot of similarities here. And I know some of you want like this definitive time of when should I do a calendar versus a butterfly versus an iron condor. And I'm not going to completely be able to give that to you because sometimes really you could do more than one and they'd be pretty similar to another one here, to another type of trade. So this has different expirations, different expirations, which complicates the trade a little bit. Butterfly spreads, all three, you have three different strike prices on that butterfly. They're all the same expiration date, okay? Iron Condor, all the same expiration date. That makes those, from that standpoint, I think a little bit easier there on that. So Vega, I'm going to say, we already mentioned this, but we said it's Vega positive. And I said it can be a little bit more complicated though. But we're going to say it's Vega positive because it is generally Vega positive. Butterfly, Vega negative, okay? That's a difference there. So if you are looking at that IV, that implied volatility, and you see, oh, my implied volatility is quite high, that may push us a little bit more into that butterfly camp. Now, I'm not going to get a lot into butterflies today or iron condors today, but I just want to give you this kind of contrast, compare contrast type thing here. And iron condors, Vega negative as well, okay? So high IVs, it may lead us to be more in the butterfly or iron condor camp versus calendar spreads, okay? So here we go. So now, question from Isaiah, are we going to consider a diagonal? The answer is no, not right now, because what I'm trying to do is I'm trying to compare these neutral strategies, and I'm going to consider these more neutral strategies, whereas diagonal spreads, and it's a good question that Isaiah brings up, because often we talk about calendars and diagonals, and there's a lot of similarities, but by changing the strike prices from that calendar to the diagonal, we're actually going to make it less of a neutralish trade, and we're going to make it more of a directional trade. So, and plus I need to kind of limit the scope of what we're talking about anyway here to a certain extent. How many legs in it? There's two legs in a calendar spread, right? They're both the same strike, but we buy the same strike price, two different legs. What about a butterfly spread? There's actually three legs on that guy, okay? And then an iron condor, four legs. More commissions, more legs, right? More commissions, more legs. One other thing I would just kind of mention, and this is just a generalization, and depending on how you construct these, you can make any of these more higher probability or any of these more lower probability. But in my experience, butterfly spreads tend to be lower probability trades than these other trades, calendars or iron condors, okay? So that's another thing. If you're willing to take a lower probability trade with possibly a little bit more reward or something, you may consider more a butterfly. But we're focusing on calendar spreads today, all right? So I'm hoping that is hoping to help you out there. And now, because we're more neutralish, what I'm going to say is we're going to consider our technical analysis. And remember, technical analysis isn't the sole means of investment research, but it is something we're going to consider here. We're going to factor in the trend. So I'm probably less likely to do any of these neutral trades on a stock that's trending strongly. Okay. And I'm also going to look at support and resistance. It's nice if we have kind of defined support levels and resistance levels to help us go for that neutral outlook on that. All right, so let me get rid of this whole document here right now. And let's look at some trades. By the way, there's a survey link in the chat today. We always appreciate your feedback. But as I mentioned earlier, one of the factors that you may find companies that look, great, like I may say, hey, look, AIG looks pretty kind of neutral. It's not really going anywhere. It goes up and down, but it's kind of reverting back to this level in here. But we have earnings coming up. And I'm going to try to avoid earnings today for that reason. Now, you can look at things like resistance and support, like I mentioned. You can also do things like throw in, say, a volume profile. Here's a volume profile. And for those of you who aren't aware of what a volume profile is, and I've talked about this in the past, But it's just basically how much volume, how much trading occurred at any given strike price here. And for whatever time frame I'm on a 6-month graph. So most of the trading was kind of in this area right here. And therefore, if I'm doing more of a neutral trade, it may make sense. The idea is it's more likely to stay in the area it's traded before. That's the theory behind it. Now, doesn't mean that can't change. Of course that can change. But so you can use other, I don't know, indicators or things like volume profile to help you out as you are trying to do this. Let's look at Philip Morris International. Kind of same thing. You can see the volume profile. Now I'm not going to do volume profile on all of those, but you can define your resistance level. I'm going to call that a resistance level. You can define your support level. I already have one on there. But I got earnings again on this, so I'm gonna skip that one as well. Now, a lot of trades probably aren't even possibilities. You look at a stock that's just trending. Generally, stocks that are trending like AMD, most technicians are going to say, well, look, that's the trend. I'm probably not going to do a more neutral trade on something that has such a strong trend. So I'm going to skip that here as well. But let's look at one that doesn't have earnings here. And of course, I invite you to try this on paper money on any stocks that you think are more neutral if they're more liquid type stocks. I'm using this S&P 100 list. Everything I've taken is off that S&P 100 list, which is probably a decent start. I'm going to call Intel relatively neutral. Do you see why? Well, look, over the past 6 months at least, we started here and we're here, and lately we've been here. So I'm going to call that kind of neutral, and we're past earnings. So there we go. So let's do an example trade here on this. And the first thing I need to do is decide where I think the stock is going to be. Okay? And now I said already kind of neutral, but let's get a little bit more precise on that. Because you can skew this a little bit. Let's say I thought it were going to be up near 22. Well, then what I may consider is doing a $22 calendar. Make sense? That would make it a more bullish trade. If I think it's going to be near 21, I'll choose strikes at 21. If I think it's going to be at 19, I'll choose strikes near 19. Of course, we don't know exactly where it's going to be, but you can kind of skew it a little bit bullish or a little bit bearish, depending on where you think it's going to be. Okay? So truly neutral would be picking a strike that's right about, like, I don't know if there's a 1950 strike that even exists on this, but I'm going to say this. I'm going to say this is kind of my target area here on this, right around 20. So I'm going to look for a $20 strike. Now, one thing I haven't mentioned yet is you can do a calendar with call options. You can do a calendar with put options. It works just the same. It works fine either way. In general, in deciding whether you're going to do call options or put options, probably the biggest factor you're going to use is, I think for most traders at least, is they're going to decide, is it in the money or out of the money? Generally, we're going to try and do them out of the money. So in this case, if I were to do a $20 strike, well, right now the stock's at 1961. That put trade, if I did puts, those would be in the money. Okay? If I did calls, they would be out of the money. Now, if I did a $19 strike, that would be a different story. But right now, that's that. So I'm going to lean towards a call here because it's out of the money. Let me give you a couple reasons. I would say more often than not, I think you're going to find the bid-ask spreads a little bit tighter if the contracts are out of the money. But perhaps more importantly is, remember, short options can be assigned early. They can be assigned anytime before expiration, and the odds of early assignment increase if they're in the money. So if we're starting out with, if we're starting out with it in the money, by the time it has to move farther, the stock has to move farther for it to actually go in the money, significantly in the money there. Okay? So that's why we're going to look at a call calendar on this. Now, George said, hey, we just had earnings. Yeah, implied volatility is going to drop after earnings, right? We can look at that. And let me just throw on that IV there. Let me just close this down here. Okay, and you can see that drop in implied volatility. In general, over time, between one earnings and the next earnings, is, IVs tend to go up between one earnings and the next earnings. So, it may continue down a little bit or something, but if history holds, it tends to go up there. And that would tend to help us for this positive Vega trade here on this. So let's do this. Let's go and let me put in, I'm going to go to the trade tab. And I'll look at the monthly options here, okay? So we got 21 days till expiration, which is kind of on the shorter end of things, but that's fine. 21 days to expiration, and we can go shorter than that. I don't know, we'll look at others and maybe we do that. And I'm going to look at the $20 strike, and I'm going to do the calls, okay? And I'm going to sell our front month. So I'm just going to click on that bid price. Okay? Now, what I'm going to do is I'm going to go out to, I want 50 to 120, 50 to 150 days, something like that. So I'll just go to April here. And I'm going to go here, and I'm going to go to that $20 strike again. But notice my spreads are nice and tight on that. Bid-ask spreads are nice and tight, 166 to 163. I'm going to hold down my control key, click on that, and now we have a calendar spread. That's a calendar spread right there. The most we can lose on this is our initial debit. Okay, it's a little hard to see. Let's see if I can make that a little bigger so you can see that. 89 cents. 89 bucks is our initial debit on that. Now, if I want to, I can go to the Analyze tab and Intel and look at it. Oh, dude, let me do this first. Let me right click on this and analyze trade. Now we'll go to the Analyze tab here. And this is what it looks like. That's what a calendar spread looks like. We said our expiration is February. Let me go to there. There's our expiration. And this is where you can see what's our max gain on this. Well, our max gain is roughly 66 bucks on this. Now, our max loss is more than that, 89. But I would submit to you that there's more to it than that. In fact, let me do this. I'm going to set my slices to break even here on this. Okay. I'm going to set my slices to break even. Let me just change my scale just a little bit, zoom in a little bit so you can see this. Because even if it breaks out here, and let's say it goes all the way up to 23, which is well outside, we're going to be losing money at this probably at 23, right? But notice what our loss is showing at that point. It's nowhere near a max loss at this stage, even at expiration, or as we get near our front month expiration, our loss is showing 18, 19 bucks or something like that. So in the areas where I think it's more likely to be, like say we go say 23, I'm going to expand this out here and expand our break even points here. And let's just do 18 to 20, I don't know, 17 and a half to 23. We'll do that, okay? What I can see is if it goes against us, and obviously we don't want it to go against us, but within this range, it is we're not going to be, we probably won't be. I guess I can't make any guarantees, but we're probably not going to be at our kind of our max loss situation, which is closer to $90 on that, if it were to go way south on us or way north on us there. So that's the trade here. Let me go back and set my slices back to break even. Break even about 18.5 and about 22, we'll say, okay? About 18.5 and about 22. Let me just draw some, I'll tell you what, this is what I'll do. Let me go here, and I'm gonna set my slices to the chart. Set slices to charts, we'll do that. This blue lines now represent where we want the stock to be. We want the stock to kind of stay in that range. That's our break even. So remember, now we're selling the 21st of February. We're buying, it was mid-April. Okay, I can't remember what the date was. It was like April 15th or something. I'm not sure. Between now and then, this is a short contract. I'm going to put a little minus sign to designate a short contract. We're selling this. Here's my long contract. As this one gets near expiration, if things are going well, what we'll look to do is we'll look to buy this back, and we'll look to sell another calendar at that point. Or excuse me, sell another contract at that point. So if we buy back the 21st of February, maybe something like, again, I don't know what the exact expiration date is. Maybe we'll go to something like 14th of March and sell that one. And so if we roll out of this one, we'll then have a new rolled calendar right there on that. Okay? So that's the gist of it. We may roll this at some point. Now, rolling doesn't save you on commissions, right? So just be aware of that, okay? Now, in terms of managing these, though, and I'll talk a little bit more about this later, but in terms of managing these, let me just flip back out of this for one sec and go back to that Word document I had and talk about management of calendar spreads. So we're going to roll or close. So close, we may just get out of the whole thing if the stock is trading near strike price near first expiration, okay? So we'll say less than 10 days. We're going to do my less than, oops, that's not right, less than 10 days to expiration on that, okay? If the short option becomes worthless, okay? Remember, that's the one, we want that, well, I'll even say near worthless, okay? Near worthless. Because at that point, we can't make any more on the short option at that point. So that makes no sense to continue to be in that contract here. Tony's saying, how do you sell the new contract with the old purchase contract? I'll show you that here in just a sec, okay? Technical breakdown. Technical breakdown. It would be, so in other words, we're a neutral trade. If this thing turns bullish, or if this thing turns bearish, it's no longer neutral, and we don't want to be in a neutral strategy. So we're gonna get out of that trade at that point. Okay. If we profit, you know, if we profit 2 times what cost to enter was, maybe, you know, that would be an example there. Approaching news such as earnings, okay? It may not be earnings, but most of the time when we talk about news, that's going to change that stock. it's earnings we're talking about there. And I'm going to say less than 10 days until expiration. Okay? So those are some management type rules we'll do on this. Okay, let me get out of this here now. And what I'm going to do is I'm actually going to place this trade. I'm going to confirm and send. Actually, let me do this. I just want to make sure I get filled. So I'm going to be willing to pay just a little bit more just to make sure I get that in there. And I'm going to put that in my calendars bucket. We're going to send that. Now, if I want to, I can put in an automatic exit on that. I can say, look, if this stock breaks above 23 or below, I don't know, 18, we're just going to automatically get out of that. How can I do that? So what I'm going to do is, let me go to my calendars. Oh, hold on. What am I doing? Calendars, right here. Here's my trade. I can right-click on this. I can create a closing order. This is to get me out of this trade now. This would get me out of this trade. But I don't want to get out right now. I'm going to make this a market order, good till canceled, and I'm going to click on this little gear over here. When I click on that gear, I can say I want to get out if INTC, just click down here, marks greater than or equal to 23, or if it marks less than or equal to 18. And that's going to automatically get me out. Let me just send that. Send. Okay. Now we have not just our initial trade, which we're in, but we have an exit order on this. Okay. Now, what about rolling? Let's say I decided I wanted to roll this trade. What would we do? First of all, I'd cancel this because I'm not going to be in those contracts anymore. I'm going to cancel those out. And you can cancel just by the way, just by going up to working orders, click on it, right click on it, and you can cancel that order. I'm not going to do that right now, but that's what you can do. Secondly, if I want to get out of one and roll it, let's say I want to get out of this short contract and roll this 21st of February contract to a, what's available here? Say March 21st, okay? How do I do that? Well, I right-click on that February 21st contract. I create a rolling order, and it's going to say sell calendar, but just look at it. What it's going to do is it's going to say February 21st, we're buying this one back. Now, it doesn't know what date I want to roll it to, so it just put in the next date, but I said March 21st. So I'm going to go to March 21st, and this would be a rolling order right here to get out of February 21st and back into, to buy back February 21st and roll to March 21st. And hopefully along the way, if you do that, you're bringing in credits along the way, okay? But at this point, it wouldn't make any sense to do that. Obviously, we're going to let that roll. In general, in terms of deciding which strike prices we're going to do, the farther out our long contract. So we went to April 17th here. The farther out that goes, the more expensive the contract's going to be. The bigger the difference between the dates of our near contract, the short contract, and the long contract, the more expensive it's going to be. It's going to be a higher potential debit, but there's also higher potential reward on that too. Okay, and if you spread these out a ways, you don't have to spread them out a long ways, but if you spread them out a ways, it gives you that opportunity to roll intermediate along the way. Whereas if they're within a couple weeks of each other, you don't have that opportunity to roll. Now, I'm getting low on time, but I want to do one more here and show you just one more as we go. So another one I was looking at is USB. Okay, we're past earnings. Our IV's lower. we're kind of neutral. So I'm going faster on this one because you already know the basics. I'm assuming we're going to be, maybe our support may hold, probably some resistance up here. That's going to be my neutral forecast on this. Let's go to trade. Let me get out of that because I don't want to do that. And what I'm going to do is you don't have to. Look, I said 20 to 50 days. You don't have to do 20 to 50 days. Let me go out 14 days. We'll go to Valentine's Day here. Here's Valentine's Day. Where do I think the stock is going to be? Well, I have strikes every 50 cents here on this. That may determine it. Sometimes that's actually kind of a rare thing. Most stocks don't have strikes every 50 cents. So where do I think this is going to be here? I'm going to assume that we're going to go kind of mid-channel, right around, what is that, close to 40, well, 48.50, $49. We'll say $49. Okay. So remember, now in this case, $49, and it's above the current price. So again, I'm going to use a call calendar on this. We've used call calendars on both of them, but just realize the process for a put calendar is just the same. It's just the same. It's just, we're going to keep it out of the money here. So I'm going to go to this $49 call calendar. I'm going to sell my near expiration. I'm going to go out to my longer dated expiration. I'm only going to go out, look, I'm not going to separate these this far. I'm only going to go out to March. This is only 42 days out. So this is a nearer term, a little shorter than the when I was kind of illustrating those kind of general guidelines I was showing you earlier. I'm actually violating that a little bit here. I'm just going shorter term. That's okay, because I just want to show you that that's possible. We did the 49. I'm going to control click on that. And there's my calendar spread on this. And what I can do is I can then, I can right click on it, analyze it. Here it is. We said expiration February 14th. So same expiration. Let me set my slices to break even. And I'm going to set my slices to my chart here. So we can kind of see, I had this extra line drawn here. Let me remove that so you can see. Here's my area, my zone that I want the stock to stay in. This is my zone of profitability, so to speak. Now, increasing implied volatility should help us out a little bit in that case. If you don't think it's going to stay in there, then you wouldn't do the trade. Furthermore, maybe you look at it and go, well, actually, I think the stock's more likely to be between here and here than what I have here. So instead of that 49 strike, maybe I'd tweak it to a 48.50 or a 48 strike. If I did that, then my break-even points would probably line up more in this area in that case. Okay? So, so there you go. But here's what I'm going to say. I'm going to say if we break below, let me get rid of this. If we break below, let's see, that's 47, 49.7. I'm going to say $47. I want to get out of this, or $51. 47 and 51. Let's put an exit order on this to get out there. So what I'm going to do is I'm going to get to my trade. I'm going to change this from single order to first trigger sequence. I'm going to right click. I'm going to create an opposite order. Now I have my entry order and my exit order. And I'm going to make this market. Good till canceled. I'm going to click on my gear. I'm going to say if USB marks less than or equal to 47, or if USB marks greater than or equal to 51, we're going to get out of that guy. Okay. Make sure when you send this that you are, and I'm actually going to, it's my mid price. I'm going to go down just a little bit to try to increase my odds of that getting filled. I'm going to confirm and send. Make sure you read all the red lettering here on this and red notes on that. And I'm going to put this in our calendar bucket. I'm going to send that, and it's thinking it has not filled at this point here. I may tweak that price a little bit just to make sure it gets filled, because in my my Wednesday managing options portfolio class, we'll look to manage this and other trades in that class. I managed a variety of different trades in that class. So make sure you check out that one. That's Wednesdays at noon Eastern time. I want to thank Barb for helping me out today. Last question was from Isaiah. When are calendars mostly implemented? When we have more of a neutral time frame, when IVs are perhaps a little lower, you want to increase your theta in your portfolio, but you aren't super directional. That's the reason why you're most to do that. And Chris said I may have tweaked that the wrong direction. I think I may have. I was kind of rushed for time on that, Chris. I'll make sure I get that filled here as I look at this, just to make sure I can get that order filled there on that. Thanks for joining me, everybody. Thanks, Barb, for helping me out. Make sure you subscribe to Trader Talks, everybody. And coming up next, we have ThinkScript studies. Check out that. And have a great day and nice weekend. Bye-bye, everybody.